Okay, let's unpack this. We're looking under the hood of, well, one of the biggest players in global finance today.
Hmm.
Their 2024 results show some pretty significant acceleration. Revenues up 16%, earnings per share, a massive 77% higher.
Yeah, that EPS number really jumps out.
It does. And noticeable improvements in efficiency and return on equity, too. So what does that actually tell us about what's driving their business?
That's exactly what we're here to find out. Our source for this deep dive is the Goldman Sachs 2024 10K annual report.
Right.
Think of it as the official word, straight from the firm itself. It's the detailed breakdown of their year, their strategy, and, importantly, the challenges they see ahead.
And our mission, using only what's in this document, is to kind of distill those numbers and narratives. We want to understand the core engines of their business,
Yeah.
figure out what fueled that strong 2024 performance, and see how they plan to create value for you, the listener, as a shareholder moving forward.
Exactly. We'll walk through their distinct business segments, dive into the consolidated financial picture, look at their capital management and shareholder returns,
Okay.
and, importantly, cover the key risks they've highlighted. It's all straight from this source material.
So let's start by breaking down their business into the main segments the 10K identifies. It lists three primary areas. What are they, and what kind of activities fall into each?
Right. So they structure themselves into three main segments. First, you've got Global Banking and Markets, or GBM.
GBM, okay.
This is where they serve major corporations, governments, and large institutional clients. It includes activities like providing strategic advice, that's advisory,
Mm-hmm.
helping companies raise capital through stocks or bonds, that's underwriting, and importantly, market making.
Market making. We hear that term a lot with firms like this. Can you give us a quick sense of what that entails, particularly as the 10K describes it within GBM?
Absolutely. So the report describes market making as facilitating client transactions across a huge range of financial products.
Yeah.
Think FICC, that's fixed income, currencies, and commodities,
Yeah.
and equities. Essentially, they stand ready to buy or sell, providing liquidity.
Oh, okay.
They might take the other side of a client's trade if needed, or, connect buyers and sellers. It's crucial for the smooth functioning of capital markets.
Yeah, you need that.
But it means they hold inventory and have to manage the associated risks. GBM also includes financing activities for these clients.
Got it. Providing that essential grease for the wheels of finance. What's the second segment then?
That's Asset and Wealth Management, or AWM.
AWM.
This segment is focused on helping both institutional clients and high net worth individuals manage and grow their assets.
Okay.
They offer a whole range of investment strategies across different asset classes like equity, fixed income, alternatives, structured through things like managed accounts and funds.
Yeah.
It also includes wealth advisory services.
So managing money for big investors and wealthy clients. And the third segment.
That's Platform Solutions, or
Right.
PS. This is where they house activities like transaction banking, which involves services like deposits, payments, cash management for corporate clients, and also certain consumer-related businesses. Though the report does note they've been strategically narrowing the focus within the consumer part of this segment.
Okay. Three distinct but related engines. Let's look at how each performed in 2024, starting with that big one, GBM. The 10K shows strong performance there, right?
Yeah, very strong. Pre-tax earnings in GBM were significantly higher, up 29% to $14.92 billion.
Wow, that's a substantial increase. What were the main drivers behind that jump, according to the report?
Well, a key factor was a much lower provision for credit losses, only $40 million in 2024, down from $401 million in 2023.
Big difference.
Huge. And the report explicitly links that higher 2023 number to commercial real estate.
Right.
So improved credit conditions or maybe performance in that specific area was a tailwind. Operating expenses were higher in this segment, though, up 11%.
Oh, okay. Why was that?
Largely driven by transaction-based, cost more activity,
Yeah.
basically, and also higher compensation reflecting the strong performance.
Makes sense. Right, pay for performance. So better credit performance and increased activity boosted the bottom line despite those higher costs. How did Asset and Wealth Management perform? AWM.
AWM also saw really impressive results. Pre-tax earnings jumped from $1.36 billion in 2023. Get this, to $4.55 billion in 2024.
Wow, an even bigger percentage leap than GBM. What's the story there?
Well, credit losses played a role again,
Mhm.
but here it was actually a net benefit of $232 million in 2024.
Benefit. How does that work?
Yeah, compared to a larger net benefit of $508 million in 2023. The report clarifies the 2024 benefit came from wholesale loan paydowns,
Okay.
while the significant 2023 benefit was tied to the sale of most of their Marcus consumer loan portfolio and also reserve reductions on corporate loans.
Ah, okay, different drivers.
Exactly. And interestingly, despite higher compensation linked to performance, operating expenses in AWM were actually lower overall, down 9%.
Lower expenses, how?
This was primarily due to significantly lower expenses related to commercial real estate held in what they call consolidated investment entities, or CIEs.
Okay, so lower real estate related costs and those better credit outcomes helped significantly in AWM. Did the report mention growth in assets under management, particularly in areas like alternative?
Yes, it did. It highlighted growth in alternatives assets under management that increased from $485 billion at the end of 2023 to $517 billion by the end of 2024.
So decent growth there.
Yep. And they also touch on their sustainable finance goals, noting they've achieved over 80% of their $750 billion target by 2030 as of December 2024.
Wow, 80% already.
Yeah, with the majority focused on climate transition.
That's definitely a clear focus area. Finally, let's look at Platform Solutions, PS. What's the performance story there, especially with that strategic narrowing of consumer activities you mentioned?
Platform Solutions saw slightly higher net revenues, up just 2% to $2.43 billion in 2024. The story here is more about strategic shifts impacting the numbers.
How so? What kind of shifts?
Well, consumer platforms' net revenues were up slightly, thanks to higher average credit card and deposit balances. But this was largely offset by the financial impact related to the planned transition of the GM credit card program.
Ah, the sale they announced.
Exactly, which they've agreed to sell. And transaction banking net revenues were lower, primarily due to the sale of a seller financing loan portfolio during the year.
Okay.
So you see these strategic portfolio changes had a pretty notable effect on this segment's top line.
That makes sense. It sounds like PS is still kind of navigating these transitions. The report also calls out a specific risk for this segment, right?
It does, yeah. It explicitly notes that future deteriorating economic conditions could lead to decreased consumer spending, or maybe a weakening in consumer credit quality.
And that would hit PS specifically.
Yeah, this would likely negatively impact revenues and increase the provision for credit losses, specifically within the Platform Solutions segment.
That's a clear link between the macroeconomy and this part of their business. Okay, we've seen the individual engines. Let's pull back and look at how it all adds up on the consolidated level. What were the key firm-wide financial numbers for 2024?
Right. Pulling those top-line numbers you mentioned right at the start, total net revenues for the firm were $53.5 billion. That's a 16% increase from $46.3 billion in 2023.
Solid growth.
Very solid. And earnings per share, again, that substantial 77% leap, reaching $40.54 compared to $22.20 in 2023.
Huge jump.
And yes, their return on equity improved significantly to 12.7% from 7.5%, while the efficiency ratio improved quite a bit too, by 11.5 percentage points down to 63.1%.
Those efficiency and ROE improvements are really quite noticeable. Better profitability.
Definitely.
Looking at the income statement highlights, the 10K notes total operating expenses were slightly lower overall, right? Despite those increases in GBM.
That's correct. Total operating expenses were $33.77 billion, down a bit from $34.49 billion in 2023.
So how did that work?
Well, while we saw those expense increases in GBM linked to activity and compensation, these were more than offset by decreases in other areas, like the lower commercial real estate-related costs in AWM that we discussed.
Oh, okay.
That led to a net decrease firm-wide. This, combined with the strong revenue growth, is really what drove that improved efficiency ratio.
Right, revenues up, costs slightly down overall. Good combination. And the overall net earnings available to common shareholders.
That figure rose substantially from $7.91 billion in 2023 up to $13.53 billion in 2024. Really reflects that improved segment performance and the expense management.
Okay. Shifting gears a bit to the balance sheet and cash flow. What does the report highlight about their assets and liabilities? Anything stand out?
Well, the balance sheet shows total loans gross increased modestly from $188.4 billion at the end of 23 to $200.9 billion at the end of 2024.
Okay, slight increase in loans.
But looking at the cash flow statement, which gives you a different perspective than earnings, we see some significant movement.
What kind of movement? Big swings.
Yeah, quite big. Cash flow from investing activities showed a net cash used of $49.6 billion in 2024.
Used, so cash going out.
Right. buying securities, making loans, things like that. And this was a much larger use of cash than the $17.3 billion used in 2023.
Okay, more investment activity. What about financing?
On the financing side, cash flow from financing activities provided a net $7.3 billion in 2024. That was actually down quite a bit from the $27.8 billion provided in 2023.
Why the drop?
Well, financing includes raising capital, like deposits and issuing debt, but it also includes using cash for dividends and those share buybacks we'll talk about.
So the buybacks use financing cash.
Exactly. So as a result of all this, their ending cash and cash equivalents actually decreased from $241.6 billion in 2023 down to $182.1 billion in 2024.
That change in the cash position is interesting. How do they manage their overall capital structure then? And what does the 10K say about regulatory requirements? That's always huge for banks.
Absolutely. The report emphasizes they manage capital primarily through issuing and repurchasing common stock, as well as preferred stock and subordinated debt.
Standard tools.
Very standard, yeah. But it's crucial to note they need regulatory approval from the FRB, that's the Federal Reserve
Oh,
Board,
the Fed.
for redemptions or significant share repurchases. They operate under a capital framework set by the FRB, meaning they have specific risk-based capital and leverage ratios they absolutely must meet.
So rules they have to follow.
Big time. These ratios are a key constraint on their capital decisions.
And what about liquidity? Making sure they have cash on hand.
Yeah, they highlight key liquidity metrics required by regulators, like the liquidity coverage ratio, or LCR,
LCR, okay.
which averaged 126% in the fourth quarter of 2024, and the net stable funding ratio, NSFR, which must be above 100%.
And what do those numbers mean, practically?
Well, these measures are designed to ensure they can meet their short-term and long-term obligations even under stress. The reported ratios indicate they are operating comfortably above the regulatory minimums.
Right.
An LCR of 126% basically means they have a solid buffer.
A cushion.
A cushion, yeah, of high-quality liquid assets relative to their potential short-term cash outflows.
Okay, so they're meeting those requirements. We've covered the segments, the overall financials, capital structure. How does all of this translate into their stated goal of creating value for shareholders? What are they actually doing?
Well, the 10K is pretty clear on this. They aim to create shareholder value primarily through, 1, earnings growth,
Which we saw.
definitely, 2, dividends, and 3, share repurchases or buybacks.
And we saw they were quite active on buybacks in 2024, right? You mentioned that affecting cash flow.
Very active. They used $8 billion for common stock repurchases in 2024.
$8 billion.
$8 billion. And this is a significant increase from $5.8 billion in 2023 and $3.5 billion back in 2022.
That's a big step up.
It is. That $8 billion translated to repurchasing 17.5 million shares in 2024.
$8 billion in buybacks in just 1 year is a substantial return of capital to shareholders.
Right.
What about dividends? Did they increase those too?
Yep. Dividends paid on common stock also increased, totaled $4.5 billion in 2024, up from $4.2 billion in 2023 and $3.7 billion in 2022.
So steady increases there.
And they also redeemed some preferred stock, redeeming $700 million of Series K and $1.5 billion of Series P preferred stock in 2024.
So increasing both buybacks and dividends and reducing some outstanding preferred stock, but all dependent, as you stressed earlier, on their performance and making sure they maintain those required capital levels.
Exactly. Strong earnings and meeting those regulatory requirements are absolutely the foundation for these shareholder return actions. You can't do one without the other.
Makes sense. Let's look forward now purely through the lens of this 10K. How do they talk about assessing the business moving ahead? And maybe more importantly, what major risks do they flag?
Okay, so the document contains, the usual forward-looking statements and targets, like achieving specific ROE, ROTE, that's return on tangible equity,
ROTE,
and efficiency ratios, or growth in certain areas, like credit alternative assets.
Okay.
However, they're always careful to emphasize the inherent uncertainty in these projections.
Standard disclaimer stuff.
Pretty standard, yeah. Things outside the firm's control. They do mention ongoing initiatives like expense savings, optimizing strategic locations, and targeting deposit growth, things they can control.
So they state their goals but acknowledge the future isn't guaranteed. What are the most significant risks they identify in the 10K that could potentially impact their ability to achieve those goals? The big worries.
Well, the risk factor section is extensive, as you'd expect for a firm like that.
I bet.
They highlight market risks, meaning challenges from conditions in global financial markets, like potential declines in asset values, especially if they have net long positions.
Holding assets that fall in price.
It's exactly. Or volatility impacting their market-making activities.
Yeah.
And just overall market uncertainty
Yeah.
affecting all their core businesses, from investment banking to wealth management.
That feels pretty fundamental to their whole operation. What about credit risks?
Credit risks mentioned include things like disruptions in credit markets. They could raise their funding costs or make it harder to sell or value assets. They also point to concentration risk,
Meaning?
the potential for large losses if, say, a small number of very large exposures perform poorly, and also the risk of being unable to reduce risk effectively, maybe due to complex securitization rules or market conditions.
And the ever-present legal and regulatory risks in finance? I imagine that's a big segment.
It's a major area for them.
Hmm.
They are subject to extensive regulation globally, obviously, and they face the risk of significant penalties, fines, or limitations on their business from regulators and law enforcement,
Yeah.
or even just substantial costs from legal proceedings. They also mention the costs and impacts of recovery and resolution planning requirements, the living will stuff.
Right. Operational risks seem increasingly complex these days, too.
Indeed. They specifically call out operational challenges related to the move to T+1 settlement in the U.S. in 2024.
Faster settlement times.
Yeah, reducing the time it takes for trades to finalize from 2 days down to 1, which requires faster, more precise processing, big operational lift. They also note risks associated with complex derivatives, which can pose challenges for confirmation and settlement.
And cybersecurity has to be a critical concern for any financial firm, especially one like Goldman.
Absolutely critical. The 10K highlights they are a constant target of cyber attacks. Constant.
Doesn't surprise me.
They see risks increasing with their expanding online services, the use of AI by malicious actors, their hybrid work model, and the reliance on all those third-party connections. A successful attack could severely damage their reputation, operations, data integrity, everything.
Yeah, massive potential impact. Geopolitical tensions also feature prominently in their risk discussion, I assume.
Yes, very much so. They mentioned disruptions from conflicts and associated sanctions, specifically citing the ongoing situations in Russia, Ukraine, and the Middle East.
Current events driving risk.
Definitely. They also point to escalating U.S.-China tensions potentially impacting global trade, investment, and financial markets more broadly.
And finally, what about strategic risks? Risks related to their own business direction and investments.
They discuss integration risks from acquisitions and initiatives. And the report actually provides recent examples of write-downs associated with strategic shifts,
Like?
including the sale of Green Sky Holdings and that planned transition of the GM credit card program we mentioned earlier in Platform Solutions. Cost money to change direction sometimes.
Yeah.
They also touch on the costs associated with managing their real estate footprint, like reducing space capacity or opening new locations.
That's a really comprehensive look at the challenges they face. Amidst all these complex risks, though, the report also emphasizes the importance of their people, right?
Yes, very clearly. They state that their people, their human capital, are their greatest asset, stressing the focus on attracting, retaining, and promoting diverse talent and fostering teamwork.
People power the machine.
Essentially, yes.
And touching again on sustainability, beyond that $750 billion target you mentioned, anything else notable?
Well, the report highlights the specific focus on climate transition within that target. It also explicitly mentions the challenges of complying with new EU sustainability regulations.
Oh, more regulations.
Yep, like the CSRD and CSDDD. Those are the Corporate Sustainability Reporting Directive and the Corporate Sustainability Due Diligence Directive. They note these will significantly increase their disclosure and due diligence requirements over there.
So more compliance work. Okay, so we've done a pretty deep dive here into the Goldman Sachs 2024 10K. We've extracted the key drivers of their strong performance, like improved credit outcomes, expense management, offsetting cost increases in growth areas. We've explored the intricacies of their business segments, analyzed the core financial statements, and detailed their strategy for returning capital to shareholders through dividends and those substantial buybacks.
Exactly. We've seen a firm that delivered really strong financial results in 2024, actively managing its portfolio and capital structure, but operating within a really complex global environment, navigating significant and diverse risks, everything from market volatility and regulatory burdens to cybersecurity threats and geopolitical instability. It's a lot to juggle.
Absolutely. And understanding these different layers, the mechanics of market making and wealth management, the strategic decisions in platform solutions, the impact of credit cycles, the constraints of capital requirements, and just the sheer breadth of global risks they manage it,
Yeah.
really provides a far richer picture for you, the listener, of how a major financial institution like this operates and seeks to create value.
It certainly highlights the multifaceted nature of their business. There's a lot going on under the surface.
Indeed. So, given this deep dive into the source material, consider this final provocative thought. How does a global financial giant like Goldman Sachs fundamentally build on managing immense risk and leveraging the expertise of its human capital? How do they continue to innovate and adapt, not just financially, but strategically, in a world where technological advancements like AI, intensifying geopolitical fragmentation, and the growing imperative for sustainability are constantly adding new dimensions to that already complex playing field?
Hmm. That's the big question, isn't it?
It is. What does their ability to deliver these kinds of results amidst such challenges tell us about the future landscape of global finance itself?
That's definitely something worth contemplating long after we finish here.
It is. And that wraps up our deep dive into the Goldman Sachs 2024 10K annual report.